Hello traders, today I'm going to be showing you the 7 ICT key levels. So these are all the ICT key levels that is in existence and that are functional at the moment. Okay, according to ICT, we have 7 ICT key levels. I'm going to be explaining each of them one after the other. Okay, so if you stay with me to the end of this video, you by then you would have known what all the ICT key levels are and how to identify them and how to mark them on your chart. Okay. Uh, Prior to my previous video, I made a video concerning ICT key levels and PD arrays, where I was showing ICT key levels and the arrangement of those key levels in premium and discount zone to print forth a PD array. So today I'm just going to be treating the key levels one after the other. I promised you guys that on that video I'm going to be making a video explaining how to identify these key levels on your chart. So that's what I'm doing today. So stay with me to the end. So the first ICT key level we have here is liquidity void. The second one is fair value gap. The third one is mitigation block. I have already mentioned all these key levels there. If you have watched my previous video, you would have get a sense of idea what I'm saying here. But today I wouldn't be explaining in details. The fourth one is breaker block. The fifth one is order block. The sixth one is rejection block, and the seventh one is old highs and old lows. So these are all the key levels that you need in trading. Okay, these key levels will give you trade setups. Okay, so I actually explained that key levels are sensitive price levels which has the ability to reverse price. So when you are trading, you look forward to enter trades at key levels because they have the potential of reversing price. So let's go and look at these key levels that you need to know that has the ability to reverse price, and that is where you're going to be able to enter your trade. So the first key level we are treating here today is liquidity void. So what is a liquidity void? A liquidity void is an imbalance in price characterized by a series of directional candles with no opposite candles. That is, series of sell candles without any buy candle in it, or series of buy candle with no sell candle in it. So if you look at this diagram here, you can see series of sell candle and there is no buy candle in this particular sell candle. So this is called an imbalance in price. It's called CB. ICT called it CB. That is sell imbalance, buy side inefficiency. That is what is called CB. So that means there is a selling imbalance and that is a buy side inefficiency. In trading, price has to maintain market efficiency. So any imbalance in price has to rebalance it to maintain efficiency. So this particular second candle creates a huge imbalance. Okay, so this particular candle is usually what they call liquidity void, but ICT will call these four candles an imbalance because if this candle should appear on, if this candle is, assuming this candle is a 1 hour candle on a 4 hour time frame, you will see that all this candle will be a single candle and it will still appear as this particular one in the second middle candle. Likewise for the buy candle, the series of directional candle with no opposite candle in it. So we have buying candle, no selling. So we have buy side imbalance and sell side inefficiency. That is called BC. Okay, so let's go to the chart and see how to identify this this imbalance in price. Now look at the chart here. This is a live chart. Now, what is an imbalance? You should, imbalance in price is just like from the name imbalance. That is something that is not balanced that needs to be balanced. Okay, so liquidity void here. So this particular candle creates a huge imbalance in price. So this is called a liquidity void. Well, I would like to count this one, two, three candle as my imbalance as my liquidity void, because this is a 1 hour time frame. On 4 hour time frame, this one, two, three, four candles is going to appear as one single candle, so it will still look like a single candle. So this is an imbalance in price. Is this an imbalance in price? That is a liquidity void. A liquidity void. This NFP candle creates a huge imbalance in price, and this particular candle is a typical example of a liquidity void. And what will price do when it creates an imbalance or a liquidity void? It has to come back to fill it. Now this imbalance, price just fill it up half, still leaving a space for it to balance. Likewise here, so you can see that price has already balanced these imbalances in price. Okay, so this particular one, price created this liquidity void, price will still have to trade back and balance it up. It may not be immediately, but price will still come back to fill it up. So that's how imbalances works. So the next one we are going to be looking at is fair value gap. So what is a fair value gap? A fair value gap is an imbalance in price characterized by the gap between the wicks of a three price action candles. The center of a fair value gap is called the consequent encroachment. So fair value gap now is also an imbalance, but what's the difference between it and liquidity void? The liquidity void is the whole candle, the whole candle, like 1, 2, 3, 4 candle is an imbalance in price, but fair value gap is that gap between a three price action candle, 1, 2, 3. You must get a three candles, then the gap in between that three is called the fair value gap, marked from the wick, that is the high of this sell candle and the low of this sell candle. You can mark it from there, and then you get your fair value gap. Then the middle of this fair value gap is called a consequent encroachment. So we have, this is a sell side fair value gap, and now this is a buy side fair value gap. So let's go to chart and identify what a fair value gap is. Now so this current price movement, now to identify a fair value gap, you count 1, 2, 3 price action candle. You can see this 1, 2, 3 candles. Then this gap between the wicks, the gap between the wicks marked from the gap between the three candles marked from the wicks is called the fair value gap. So to mark a fair value gap, I have to mark it from the wick. Okay, you can see I've started from the high of this wick of this candle and the low of this wick of this candle. So this is called my fair value gap. You can see price is already bouncing off from the consequent encroachment, that is the center of this candle. Okay, so yeah, I told you from my previous video to mark your PD arrays, but now I'm treating key levels. I'm not treating it as a PD array. You have to determine your premium and discount zone. So for now, I'm just teaching you how to get your fair value gap. Now you can see there's a liquidity void here, but for you to get the fair value gap in it, you count 1, 2, 3 candles. Okay, you can see the liquidity void can still be a fair value gap if you can see what price is doing. Price moved is bouncing off from this fair value gap. You can see, though it didn't reach the consequent encroachment, but you can see price is bouncing off from fair value gap. See, bouncing off, try to bounce off again. Okay, so these are key levels in price. So price respect those key levels. They are sensitive to price. Price bounces off from it. Okay, so we're gonna go to the next key level. So the next PD array on the list is mitigation block. Okay, so what is a mitigation block? A mitigation block is the other block that is overrun when price shifts market structure without taking out liquidity, or liquidity is anyone. Okay, so what I mean overrun here is, look at this diagram here. Okay, so what I mean by overrun is this: if this candle had closed above this high, this line above here now, my other block would have been this black candle. Okay, I'm not going to explain what an other block is yet. So it is around the sixth key level. Okay, no, the fifth key level. So by then you will understand this. Maybe after that you come and watch this one again. So if price had closed above this guy, let me say this green candle had closed above this guy, this black candle would have been my other block. So but this high fell to close above this guy. It didn't even trade, it didn't even take the liquidity. Liquidity is above this guy. So then immediately it came back to close below this low. Then we have a market structure shift here. Okay, with this market structure shift here, though I did not mark it yet, so I'm going to mark it on the chart. So this market structure shift here, this other block now, this overrun other block now, the whole body of the candle from the wick to the wick now becomes the mitigation block. So you can see when immediately price closed below this low, price have just retraced back into this other block, tap into it and continue dropping. That is a sell mitigation block. Then for a buy mitigation block, you can see price failed to close below this low or take out any liquidity below this low, and then downshift market structure. Then this supposed to be other block now becomes a mitigation block. Okay, so let me show you on the chart what I mean by a mitigation block. So for now, I'm not seeing an active running. I want to see the one that has been mitigated. So do we have many other mitigation blocks here, but I want to see the one that is mitigated. Okay, let me go back in time. Mitigation block, where are you? Okay, let's see this guy. Okay, now this is an example of a mitigation block. You can see there is a low here. Okay, you see price made a low, it made a high. This low now fell to close below this low or take out any liquidity below this low, and then price came back and shifted market structure to this top side. Okay, so there is a market structure shift here. SMS. So this supposed to be other block, because if price had closed below this low, this green candle now would have been my other block. But since price failed to close below the low, now this other block now becomes my mitigation block. Okay, I'm not showing you this key level for you to enter trade. I'm just showing you what it means. My next video I will show you how to use it to enter trade. So you can see what price did. Immediately after price closed above this guy with this candle, price went up, came back, tapped into it, then bought a little, okay, and continued selling. This is because this mitigation block formed against the trend. That is why it failed. Okay, so I'm just showing you what mitigation block is. So it is everywhere on this chart, but most of the time you see it on the lower time frames, like 5 minutes, 15 minutes, 5 minutes, 15 minutes, 3 minutes, the time frame for entry. That is where mitigation block are always common, but these higher time frames you rarely see mitigation block that is mitigated. Okay, look at this one. This one is a perfect example. Okay, so you can see this pattern here. This one is going with the trend now, so you can see price made a high, made a low. Now this made another high that fell to take out the liquidity above this high. Then before it broke down to this low. So let me remove this for you to see. So over here I have a market structure shift. Market structure shift over here. This candle now closed below this low. Then this supposed to be this black candle. If price had closed above this guy, this black candle would have been my order block. But now it's not overrun. So this guy, this whole candle now, this whole black candle becomes my mitigation block. You can see the precision of this mitigation block. You can see immediately price closed below the low. It came back, tap into it, just tap, bam, and now started dropping. So this is exactly how key level functions. So this is a mitigation block. So let's go to the next PD array. Let me delete this. The next PD array we have on the list is a breaker block. Breaker block is the same thing as mitigation block, but the difference is that what is a breaker block? Let me just define it. A breaker block is the other block that is overrun when price shift market structure after taking out liquidity. So that is the only difference. Mitigation block doesn't take out liquidity before it shift market structure, but breaker block does. So you can see what I'm trying to say. Explain about the mitigation block now. Breaker block now closed above this guy and takes out liquidity. It mustn't mean that it will close above. It can use the wick to hunt the liquidity. Okay, you can use the full body. When you use the full body, you know we have a break of structure. Okay, now price down, and with this break of structure here, this black candle became the other block. Then price immediately overrun this other block. I mean overrun because it couldn't hold, so price overrun it. So after the overrunning of the breakup other block of the other block, it now became a breaker block because price broke through this other block. Okay, so the retracement of this other block to the breaker retracement of the price into this breaker block will now give you an entry for a sell. Likewise for this buy breaker block. So we can see immediate price closed above this guy, came back, and then price went up. So let's go to the chart and see if we can find a breaker block. Okay, all these things are not mitigated. I'm looking for a mitigated breaker block. Oh yeah. I don't want to drop into the 5 minutes time frame. I want to see all those things, all the things I'm looking for here on the 1 hour time frame. Okay, we have an example of a breaker block here. Okay, so you can see price made a high here. Okay, price made a low, then the next high price created closed above this guy, then price now shifted market structure below this low. You can see then this black candle now, which was supposed to be the other block, now became the breaker block. You can see the precision of price. Let me enlarge this so you can see. You can see that this high of this candle closed above this guy, so immediately price closed below, it came back to tap into this guy before beginning to make a massive sell. Okay, Another example, let me look for another example of breaker block. Now I have a typical perfect example of a breaker block. Okay, now look at this candle price, look at this price action. You can see there's a break of structure here. There's a break of structure here. And then this is supposed to be my other block. This guy here is supposed to be my other block. Okay. Now, instead of this other block to hold price now immediately overrun this other block and close below this low. We have another market structure shift here, but I like to call this a change of character because this is a typical switch of order flow. Okay, so I have a market structure shift here. What am I doing? I have a market structure shift here. Okay, so can see immediately price. You can see immediately price shifted below this guy. Price now have to mitigate this guy, trade into this breaker block immediately, and continue selling. So on the lower time frame, we can just join. You can go down to 5 minutes time frame to make this entry. Okay, look for another pattern, market structure shift here on the 5 minutes time frame. This one candle on a 1 hour time frame will give you that entry. Okay, so if you just go to your chart, you will find all. You can see over here we have a mitigation block pattern high. There's a high here, there's a low here, there's a high here that failed to close above this high or trade above. Then price now shifted market structure and price immediately mitigated and dropped to mitigation block. So if you go to your chart, you can see all this pattern everywhere. Let me just make this guy whole. Because of time, this video is already taking a longer time, so I'm not going to be showing you all the breaker blocks and mitigation block, but just follow this pattern that I show you. You will see all of them here. Now look at a breaker block pattern again here. You can see it here. You can see price traded below this low. Okay, and then there's supposed to be other block. Price now close above with this. Price now close above this high. It's actually a low though. Lower. Is that, yeah, lower high, yeah, lower high. Price now close. You can see the supposed to be other block now became the breaker block. You can see the precision. You can see how price has to just tap into it with this candle. Okay, this particular candle. See how price tapped into it, and then begin to rise up. Okay, it's better if you are following trend. Okay, so these are key levels. ICT has is this kind of precision, entry precision, that you can manage your stop loss. Okay, so now let's go to the next key level. We have order block. Now this is sorry now this is where I explain order block. What is another block? Another block is the opposite candle in a series of directional candles. What I mean here is, now directional candle, that means the trend. Now this is a sell market, so you can see we have a sell candle, a sell candle, a sell candle. We have a sell candle, a sell candle, a sell candle, a sell candle. In these sell candles, the first opposite candle here is this green candle. So this candle became the other block. Okay, so you can see here too, we have sell candle. The first opposite candle we have here is this guy, this green candle. This is also the other block. Look at the buy side. These are green candles. Then the first opposite candle we have here is this black candle. It became the other block. It becomes the other block. I'm sorry for using past tense. So now we have the buy candles here. Then in this buy candle, the first opposite candle we have here is this black candle. That became the other block. Okay, I'm going to go to chart and show you what's if I can find other blocks. Now, other blocks are everywhere, but price doesn't actually trade to other block because it's the sixth key level. If you watch my previous video, in arrangement of key levels according to your priority, you have to consider fair value gap, liquidity void, fair value gap, mitigation block, breaker block, then before you get to other block. So price has to pass through all these things before you get to other block. So most of the time price doesn't get to an other block. Fair value gap always take the lead. So you can see that this is another block. This is another block. So you can see a series of directional candle in this after this break of structure here. After this break of structure here, okay, you can see this is if you are considering these buying candles, the first opposite candle we have here is this black candle. So this became an order block. So other blocks are everywhere on the chart. You just have to know that other block is the opposite candle, the first opposite candle in a directional candle. Okay, now look at as like price tapped into this other block here. All right, look at this guy. I got one here. Now you can see there is a break of structure here. Then there's a break of structure here. Don't mind my chart. I'm not making it look nice because I'm not doing graphics design here. Okay, in these cell candles, one, two candles. The first, the opposite candle here we have is this guy. Okay, that became the other block. Though I didn't define this other block precisely based on business terms, or how economics would have defined it. Okay, but you can just go to Google and get a full definition of an order block. But I'm just showing you how to the explanation that will give you the idea of what you're looking for in a chart. You can see after price make this break of structure in the retracement of price, the other block was the guy it used was the key level that held price and reversed it. Alright, so I don't want to waste time on this. Just know that other block is the first opposite candle on a chart. So the next key level we have here is the rejection block. So rejection block is the area marked by the wicks of a swing point. Price doesn't usually reaches this last PD arrays, okay, because the first PD arrays always take the lead. So the rejection block is something like this: area marked by the wick of now this is the wick of this candle, area marked by the wicks of a swing point, because this is a swing point. Now this candle, 1 2 3 candles now give me a swing point. So this area marked by the wicks of this swing point became the rejection block. You can see after break of structure here, price didn't, this is a breaker block structure. Okay, but price didn't use a breaker block. Price has to use the rejection block. See how price didn't close, didn't trade into, couldn't close inside this rejection block. It has to close outside this rejection block. Okay, so there are many of it here on the chart. Let me see if I can still find rejection blocks. All these key levels are everywhere on the chart. Okay, so For this guy I marked previously, my rejection block, I said I defined rejection block as the area marked by the wicks of a swing point. Okay, yeah, you also have to know how to mark a swing point, but that's not what I'm showing you here. So, for you to get the swing point, you need a three price action candle. One, this one, two, three. Okay, so price gave me a swing point here. Then the area marked by the wicks of this swing point is called rejection block. Okay, this is my rejection block here. Okay, you can see here too. We have one, two, three price action candle. Then the area marked by this the wicks only. The wicks. You're not gonna mark the body. It's the wicks you're gonna mark. This is a rejection block. Okay, these are one of the last places price has to get to. Okay, this is a rejection block. It's still here at the top of this place. The wicks, when you mark only the wicks of a swing point, it becomes a rejection block. Okay, so you can be seeing these things are everywhere on the charts. For this guy, the wicks, if you mark the wicks here, this becomes a rejection block. Price doesn't usually get to a rejection block, okay, because other block fair value gap, the active PD arrays, the most active PD arrays are the liquidity void, because those ones are imbalances. Price has to balance them immediately or later. The most active PD arrays are the fair value gaps, the liquidity void, the mitigation block, the breaker blocks. Those guys are the ones price have to get to first. Okay, if price is not balancing price, okay, he's gonna the next target is breaker block or mitigation block. But if there's no mitigation block or a breaker block, that's when you be considering other block. Then rejection block, the other block will not even allow price to get to a rejection block. Okay, except there is no other block, and it's almost impossible for you to have a break of structure without an other block in it. So rejection block are just for you to know, just for you to know about it, because in rare cases price respects rejection blocks. So rejection block over here, now you can see we have a break of structure here. What did I do? No, it's not really a break of structure. I didn't see the place where price respected a rejection block. Okay, I think I have seen it here. So I have a market structure shift here, or a change of character here. I have another one here, a break of structure, and now in this place there is no fair value gap, but we have another block here. Price didn't respect this other block. Price didn't respect this other block. This guy here, this particular guy here, price didn't respect it. We have a mitigation block here too, because price made a high, made a low, made a high that didn't close above the high before it dropped. You can see price didn't respect this guy too. Now the price now use a rejection block to sell. The rejection block is the area marked by the wicks. Though this colored place I put is my Asian range. I've used an indicator to mark my Asian range for it to make me easier for me to know. I usually like trading the London Open, so it's important that I leave my. So you can see this is a rejection block. See, price didn't use any of these PD arrays, but the rejection block was what he used to sell. Okay, so you have to know all the PD arrays, all the key levels for you to. Oh, my PC is low. Okay, let me be fast before this battery dies. So the last key level I have here is the old highs and lows. Okay, this is simply the highs and lows made in swing structures. Okay, in rare cases price goes for the old highs and lows, and when price does, we call it a liquidity hunt. Okay, Price looking to take out liquidities. That is when price goes for the old highs and old lows. Okay, over here, a typical example is here. This is an old low. Price trade into it. For you to know price is respecting an old high or low, is the body of the candle would not close, or will not close below that low or a high. Okay, if price just now trade through it with weak and rejects from that place, that's when you know that price is respecting that key level, that old high or low. But when price close below it, you know that price is not respecting it. Okay, so just any old high or low. Okay, the lows, the highs. This is what is called old high. The highs and low. There are cases where price have to go there to hunt for liquidity. All key levels are called liquidities. Okay, we have internal and external range liquidity, but that is a topic of another day. So the reason why price moves is to to look for liquidity and to maintain price efficiency or market efficiency. So price has to go to from internal to external range liquidity, and in doing so, maintain efficiency. That is the only thing price does. Okay, so this is ICT for you. I hope this video gave you an insight about trading. So now you have already known the key levels you are looking out for when you are trading, where you look to enter price. So maybe in my next video I will show you how to actually make use of these key levels. I'm just giving you a rough idea of key levels. I'm not showing you exactly how to use it to enter trade. You mustn't trade all key levels. Okay, according to ICT, you got to choose the ones that is good for you. Okay, like me now, I use almost all of them, but I prefer most of the time. There are conditions I prefer other blocks. There are conditions I prefer breaker block and mitigation block. Those guys are almost the same thing. Okay. Then the condition I prefer fair value gaps. Okay. But most of the time people like fair value gaps because those guys, they are the first key levels. They are the first key level price has to encounter. So knowing how to trade from a fair value gap, you're going to be catching more trades than someone who trades only from the other block. Okay, so this is where I end this video. I hope you like this video. If you like this video, if this video was helpful or is helpful to you, you can refer someone to my channel for them to learn as well. Okay, these are things people pay money to learn, but this is what I'm giving you. I just want you to know how to trade and succeed in this game. Okay, if you have any question, drop it in the comment section. I'll do well to respond and to answer your question. If you have video you want me to make for me to explain things for you, you can stay, let me know, then I will look into it, and then I will give you my answer. But now, till next time, bye bye.